The Greeks in options trading refer to the metrics that tell us about the option contract. And when trading options, it's important to know the Greeks because it'll give you an edge on your trade. It tells you a more complete story about what you're going to get yourself into, your trade. Let's start with delta. Delta tells us how much the option price will go up or down based on every $1 change in the underlying security. Delta is usually measured as a decimal, like 0.35 or 0.8 or 0.9. And if you're looking at a call option, for example, one that has a 0.8 delta, then it means that for every dollar that the underlying security goes up, the option price will increase by 80 cents. And yes, if the underlying security goes down $1, well, the option would go down by 80 cents. Oh, and when we speak of delta, we express it as a whole number, not as a decimal. So a 0.8 delta, well, you would say an 80 delta in that case. But it doesn't end there. Delta also tells us approximately the chances that the option contract will expire with or without value. So an option with an 80 delta means that there's about an 80% chance that it will expire in the money or with some value. And when we buy options, when we want the options to expire with value. Next we have gamma. Gamma tells us the rate of change between an option's delta and the underlying security's price. So higher gamma tells us that the delta could change a lot, even with minimal price changes in the underlying security. So if you're buying a call, for instance, higher gamma means that the price of the call option will increase if the price of the underlying security goes up. You could also say that with higher gamma, the less you can trust delta. Now, if your option strategy is to buy deep in the money options, gamma isn't all that important because it's likely that it's going to be a low number. Gamma is important for at-the-money call options because with an at-the-money option, if the stock price moves just a little and then the option is out of the money, then it loses all of its intrinsic value. Okay, so next we're going to deal with theta. Theta tells us how much the option will lose in value each day, assuming the underlying security doesn't change in price. Since options lose value every day as they get closer to expiration, theta is going to be expressed as a negative number, because it's the amount the option will lose in value each and every day. So let's say you have a theta of minus 0.1. Well, that means the option will go down in price 10 cents a day, assuming the underlying security doesn't change in price, but it will. So options with a shorter expiry will have a higher theta value than options that expire further out. Okay, next we have Vega. Vega measures an option's sensitivity to implied volatility. Vega tells us the change in the options price for a 1-point change in implied volatility. And options are more expensive when market volatility is high. Just like when volatility is low, well, option prices go down. Let's say you're thinking of buying a call option, and the option costs $100, and its implied volatility is 20 and has a Vega of 12. And then, let's say volatility goes up. The implied volatility goes from 20 to 22. Well, to calculate the difference in price that the call option would experience, you would multiply Vega by the difference in volatility, and that's the amount you would add to the call option's price. So in this case, the option price will increase 24 cents to $100.24 because 0.12 times 2 is 24 cents. Next we have rho, and rho tells us the option sensitivity against changes in the risk-free interest rate. That's the interest rate paid on treasury bills. Rho is expressed as the amount of money the option will lose or gain with a 1% change in interest rates. So it could be a positive or negative number. For example, let's say you're considering an option that has a rho value of 0.1. In this case, a 1% increase in interest rate would increase the option value by 10 cents. So if you expect interest rates to move before your option's expiration, rho is something you might want to consider.